Welcome to the National Credit Awareness and Resolution Association podcast at NACARA.org, your source for navigating debt repayment challenges during tough economic times. Today we'll explore how small business owners can more effectively use creditor tools, specifically commercial and industrial lending evaluations. NACARA aims to bridge the gap between debtors and creditors as a paradigm shift allows debtors to propose their own repayment solutions. Let's get started. Financial performance and other considerations. Creditor analysis of your ability to repay. Creditors will take a deep dive analysis into your financial performance of revenues, profit margins, income and cash flow, leverage, liquidity, and capitalization. They will look at the last fiscal 3 years and year-to-date, or at least quarterly performance, to identify trends and anomalies that have affected your past operating performance. Also, depending on the size and complexity of their lending exposure with you, creditors will uncover your repayment potential and their root causes as applicable. For example, on the following. Number 1, cash flow. The debt service coverage ratio, which is your ability to repay. Global cash flow for individuals and businesses. An interest reserve, the interest that's funded for any construction loans. Creditors will monitor and know the adequacy of your ability to repay on a continuous basis. They will evaluate the cash flow trends, particularly declining trends, including a comparison to industry peer performance as well. They'll try to make sure any renewals or extensions are not just covering up repayment issues. They'll consider the level and trend of the debt service coverage ratio in assigning a credit risk rating. In an economic downturn, it's possible you have placed increased repayment reliance from other global cash flow sources. Creditors will ensure they don't double count your sources of cash flow. To do that, however, they will need to ask for your complete business and personal tax returns, including the guarantors. This is all the schedules. They will be able to carefully review the financial contributory strength of all obligated guarantors, including any individuals and legal entities that guarantee the loans. As for an interest reserve account, as applicable, the lender will confirm the reserve amount will be adequate for the needed financing period. They will make sure that any cash flows generated from the collateral property go to service debt and continuing monitoring the project lease-up. They, rightfully so, will be all over any and all cash flow sources, if you will. Let's talk about net operating income, NOI. Stabilized NOI, fully leased with maximum rental income, like on an income-producing property. The vacancy impact, which is the direct reduction of rental income. They'll look at the operating expenses, all the CRE maintenance. They'll look at debt yield. That's the risk in the deal, the viability and stability of the deal. Lenders will focus on why units are vacant, for how long and exactly how you intend to getting them leased. They will carefully review the key or increasing expenses from an historical perspective and ask you any necessary questions to understand these extraordinary expenses. So you have to understand your expenses and why they're increasing. As they monitor your loan's performance, they will compare the current debt yield to that of the original loan underwriting and to policy underwriting thresholds for a similar new loan today. For example, a low debt yield will require additional analysis, and the guarantors will very likely be asked to increase their personal guarantee, offering additional collateral even, or asking to resize ask for a resizing opportunity to increase the debt yield to policy norms. Okay, the creditor will look at the deal as if it had taken back the collateral with the current debt yield, and they'll see that that's not a problem that you'll be see if that's not a problem that you'll be expected to fix. You need to fix it because it is your problem, not the lender's. They'll also take a deep dive into profitability. Sales, top-line revenue performance, expenses, how you control the costs, and your profits, the benefits. Lenders will measure efficiency and trends in sales revenue, gross and net profit margins, controlling other notable cost and expense ratios. They will determine the reason behind material changes in each of these key metrics, identify material expense trends increases as a percentage of sales, and what the outlook is. They will understand what is driving the profit margins and what needs to happen in the future to improve them. They will ask any necessary questions until they're satisfied, so be ready if you're not already prepared with all these answers. Next, they're going to look in at the efficiency of the operations. For example, inventory days on hand, the average time it takes, average days to sell the inventory. They'll look at accounts receivable days, how many days on hand, including accounts payable days on hand, the average time it takes to pay your trade suppliers. Lenders will request detailed inventory reports that can be used to conduct an inventory inspection, even by sample testing and to ensure accurate reporting. They will hold you to account for any material discrepancies. The last thing they want to do is go and tap some box on a shelf and find that it's empty when it should be full. If there are material differences on the days on hand by comparison of values of similar same industry companies, they'll dig deeper with an inspection. They're going to find out what's going on. They'll see if and how much functional or technically obsolete inventory there might be in stock. With a detailed current accounts receivable ledger and accounts receivable customer list, if you have those reports on hand, they'll carefully analyze ineligible accounts receivables, those that are like past dues and concentrations and so forth, and determine their collectability by asking you, very conceivably here, how much and when you're going to get for all material accounts receivable. They want to have a clear idea of how much cash will be collected and by when. As suppliers play an obvious key role in the success of your operations, they'll carefully analyze the accounts payable repayment capacity over time to help determine how efficient you are operating and if you're unable to pay your supplier creditors on time. Similarly, with an accounts payable aging report on hand, you'll be asked how much and when for material past due payables as to when these will be paid and how that will affect future inventory purchases. There will also be a deep dive into leverage, funding sources, and capacity. All the financial sources, including earnings, debt capital, equity capital, to meet obligations, ability to manage finances. Lenders will determine the viability of each funding source and if those sources of capital are available or sustainable. They will determine how possible refinancing might be and at what cost and on what terms. You'll be asked as either a sponsor or guarantor if you are both able and willing to inject additional capital. They'll check to see if the projected period to delever is sustainable, if it's a sustainable level, and whether it's reasonable or acceptable. They will confirm if the cash flow analysis relies on overly optimistic or unsubstantiated projections, and even stress test the projections for a downside case. So they're going to go deep, okay? They will determine your ability to meet your obligations and the extent of any variances to your performance plan. They're going to look at that too. They will also document any poor structure elements of your loan, like limited or light covenants, and seek to install meaningful covenants going forward. Finally, they will check to see how vulnerable you are to a sharp economic downturn and any business cycle swings. They're also going to look at liquidity. These sources, which include cash on hand, short-term funds, cash flow management, secondary sources, cash burn. Creditors will review your liquidity needs if primary sources are sufficiently available or if secondary sources need to be liquidated to meet current obligations. This will include a review of current loan maturities, the size and timing of repayments, interest rates, uncollected receivables, and obsolete inventory. They will determine the root cause for liquidity problems. They'll analyze whether there's any net cash burn, confirm how much time is needed before returning to positive cash flow, and the sources to recapitalize. You'll be asked to defend the cash burn rate and how you intend to lower it. They're going to look at performance to plan, P2P, budget versus actual variance analysis, where we have a performance evaluation and expectation review, Variances need to be understood and explained as to why they occurred. The creditor needs to get and maintain confidence with your budgets and whether they need to be stressed or adjusted for the creditor's underwriting purposes. In other words, the lender's base case. It's a stressed pro forma. Will future pro forma forecasting be based on historical variances? And if not, what reasonable adjustments are necessary? Is the budget overly optimistic if the creditor has any doubt? They will ask you questions. They will monitor any revisions to plan if necessary. Depending on your P2P results, you may be asked to prepare a variance analysis on a monthly, quarterly, or annual basis. Other C&I loans are going to look at pro forma outlook, the realistic outlook, okay? Future forecasting of your financial performance. Now the assumptions, their projections and educated guesses. They'll look at cash budget, that's the budget plan on debt repayment workouts. During times of economic downturns, lenders will use pro forma statements to structure workout or loan modification repayment solutions. They will ensure these statements are conservative in both revenue and expenses and include upcoming one-time expenses. Depending on how severe the current economic conditions are, you will be expected to prepare your own repayment plan supported by your own pro forma statements. You should bring detailed, well-supported, and footnoted explanations on the assumptions that you've used. You can propose temporary repayment terms that are supported by the pro forma statements, with the updating and reporting frequency adjusted as necessary. Lenders will assign and adjust credit risk ratings as the repayment risk changes according to regulatory guidance. Under more extreme circumstances, you can use a cash in and cash out monthly budget to show possible debt repayment solutions. Next, they're going to look at management, the transition of leadership. Economic challenges must be successfully managed by skilled leaders, and creditors will need to understand your succession management tools and planning for all key positions, not just at the most senior level. Identify any recent or pending retirements, and how might those changes and their tangible contributions in staffing impact your operations and competitiveness. Speaking of that, they're going to look at competition, new or pending direct competition for market share, right? Customers lost to competition, the negative impact on your operations. New competition can affect your operations and ultimately your ability to repay your loan. Lenders will want to know the potential loss of market share because of lost customers and the decline in revenue and profits. They'll determine if increased price competition is likely with new competitors that enter the market with lower prices, affecting profit margins and impacting your ability to repay. Perhaps this will affect increased marketing and advertising expenses, right? They'll seek to understand the strategies you plan to use in being proactive in mitigating new competition risk, how you'll differentiate yourself from your competitors. There's a lot to ask for, so be ready. In fact, be ready and be prepared to present your own repayment solutions before they even ask. Now let's go back and talk about the root cause considerations and getting to understand the root causes for any deficiencies and issues. Lenders seek to transact safe and sound underwriting, understand your company's management, your industry, all in conformity to the lender's credit policies, with any material exceptions adequately mitigated and documented. Underwriting is the process by which creditors structure a credit facility to minimize risks and generate optimal returns for the risks they insure. And sound underwriting provides protections such as coordinating loan repayment with the timing of your cash flows, effective use of financial performance and reporting covenants, and having sufficient collateral, thereby increasing the likelihood of collection or full repayment. Management is also very important to creditors as they want to understand and confirm your character, your capability, and the stability of your management team. And they consider all your qualifications, your experience, and effectiveness in developing and implementing appropriate business and financial strategies. Competency and integrity cannot be overstated here. The ability for you and your management team to guide, exploit opportunities, Develop and execute plans and react to market changes is extremely important. For the creditor to succeed, they need you to succeed. An unexpected loss or even one or two key employees can be detrimental. Even the most experienced management teams can be challenged by high growth, for example, and common reasons for business failure and other factors. But finally, creditors will seek to understand the conditions in which you operate your business, the elements like cyclicality, competition, technological changes that you're likely to experience. And most industries experience some degree of cyclical volatility, and some industries are exposed to seasonal variances too, affecting your operating performance and financial condition. All these things they're going to dive into to find out the root causes of what's going on. And technological changes that are out there, new competitors, substitute products, everything can affect your financial performance. When you prepare and present your own financial repayment plan, be sure to thoroughly address these factors, especially the root causes for any underperformance in any of these sectors. This short ad is sponsored by the Debt Crisis Problem Podcast. Attention listeners, please join us at tunabudget.com to tune into the Debt Crisis Problem Podcast, where in plain English we discuss the 20 risks that could soon fuel a serious economic downturn. We explore these critical risks and offer practical insights for navigating financial uncertainty. Join us for thought-provoking discussions that encourage transparency and awareness. Subscribe now to stay informed and be ready for whatever comes next. Let's look for structural weaknesses and underwriting deficiencies. Okay? Be on the lookout. Creditors will also be looking to identify any structural weaknesses in your loans. Structural weaknesses are underwriting deficiencies that can compromise a creditor's ability to control a credit relationship when economic or other events adversely affect the borrower. During an economic downturn, and especially during seasons of default and restructuring, creditors and you will quickly come to understand if there are structural weaknesses in your borrowing relationships. Here's what creditors will be reassessing as they address your ability to repay. Remember, they need to understand if there are any structural deficiencies, as these can directly impact any negotiations you have. So why shouldn't you be aware of what the creditor is looking at too? So be on the lookout for an indefinite or speculative loan purpose, and an indefinite or overly liberal repayment plan, a non-existent, weak, or waived covenants, inadequate debt service coverage, elevated leverage ratio, inadequate tangible net worth, insufficient collateral support, inadequate collateral documentation and valuation, overly aggressive loan-to-value or advance rates, inadequate guarantor support, repayment highly dependent on projected cash flows, repayment is highly dependent on projected asset values, or repayment is highly dependent upon projected refinancing or recapitalization. Now let's look at some yellow and red flags, indicators of potential repayment problems. I'm just going to name about a dozen and a half or so yellow or maybe even their red flags, or otherwise indicators of potential problem loans. These are primarily coming from the Federal Reserve Bank's Commercial Bank Examination Manual, Section 2080.1. First, working capital advances used for funding losses. A business uses advances from a revolving line of credit to fund business losses, including the funding of wages, business expenses, debt service, or any other costs not specifically associated with the intended purpose of the facility. Again, these are yellow and red flags that the creditor is going to be looking at, and they're otherwise indicators of potential problem loans. You need to be aware if these things are happening. Document. These are the root causes too. How about working capital advances funding long-term assets? A business will use working capital funds to purchase capital assets that are normally associated with term business loans, long-term business loans, and yet they're using working capital. Next is trade creditors not paid out at the end of the business cycle. While the lender may be paid out, some trade creditors may not get full repayment. This can cause a strained relationship, as unpaid trade creditors may be less willing to provide financing or offer favorable credit terms in the future. If they don't get paid, what do you think is going to happen? In turn, the business will become more reliant on the lender to support funding needs that were previously financed by trade creditors. So your lender is going to see if your trade creditors are paid out at the end of the business cycle when they should be. Overextension of collateral. The business does not have the collateral to support the extension of credit, causing an out-of-borrowing base situation. Call it out-of-borrowing base. Review the borrowing base certificates to verify that coverage meets the prescribed limitations established by the lender's credit policy for the specific asset being financed. So if you're overextended on your collateral, that's another big red flag. How about the value of inventory declines? So in other words, if a business does not pay back the lender after inventory is converted to cash or accounts receivable, the value of the inventory declines. The vendor retains a senior lien interest in the inventory superior to that of the lender's interest. Other causes of inventory devaluation include obsolescence, a general economic downturn, or, in the case of a commodity, market volatility. Declines in inventory value will commonly put a working capital facility in an out-of-borrowing base situation and require the excess debt to be amortized and repaid through future profits of the business. Another red flag. How about collectability of accounts receivable declines? The increasingly past due status of accounts receivable or deteriorating credit quality of accounts receivable both result in non-collection of receivables. This can cause an out-of-borrowing base situation for a lender as well. Another red flag, working capital advances used to fund long-term capital. Funds may be inappropriately used to repurchase company stock, pay off subordinated debt holders, or even pay dividends on capital stock. Let's talk about accounts receivable, another red flag area. A slowdown in the receivable collection period. This symptom often reveals that the borrower has become more liberal in establishing credit policies, has softened collection practices, or is encountering an increase in uncollected accounts. Another focus on inventory. Noticeably rising inventory levels in both dollar amount and percentage of total assets. Increases in inventory levels are usually supported by trade suppliers, and financing these increases can be extremely risky, particularly if turnover ratios are declining. The increase in inventory levels or lower turnover ratios may also be related to the borrower's natural reluctant to liquidate excessive or obsolete goods at a reduced price. Many businesses are willing to sacrifice liquidity to maintain their profit margins. Slowdown in inventory turnover. This symptom may indicate overbuying or some other imbalance in the company's purchasing policies, and it may indicate that the inventory is slow moving. If the inventory is undervalued, the actual turnover is even slower than the calculated results. How about the existence of heavy liens on assets? Another red flag. Evidence of second and third mortgage holders is a sign of greater than average risk. The cost of junior money is high. Most borrowers are reluctant to use this source of funds unless conventional sources are unavailable. Another red or yellow flag. Concentration of non-current assets other than fixed assets. A company may put funds into affiliates or subsidiaries for which the lender may not have a ready source of information on operations. The next red flag, high levels of intangible assets. Intangible assets, which shrink or vanish much more quickly than hard assets, usually have very uncertain values in the marketplace. In some cases, however, intangible assets such as patents or trademarks have significant value and should be given considerable credit. How about substantial increases in long-term debt? This symptom causes increasing dependence on cash flow and long-term profits to support repayment. Another, a major gap between gross and net sales. This gap represents a rising level of returns and allowances, which could indicate lower quality or inferior product lines. Customer dissatisfaction can seriously affect future profitability. And how about this one? Rising cost percentages. These percentages can indicate the borrower's inability or unwillingness to pass the higher costs to customers or its inability to control overhead expenses. Another flag, a rising level of total assets in relation to sales. If a company does more business, it will take more current assets in the form of inventory, receivables, and fixed assets. They're going to be aware and be concerned when assets are increasing faster than sales growth. Last one here, significant changes in the balance sheet structure. These changes may not be the customary changes mentioned before, but they are represented by marked changes spread across many balance sheet items and may not be consistent with changes in the marketplace, profit or sales, product lines, or the general nature of the business. Thank you for joining with us. Today we covered the Creditor tool, commercial and industrial lending, as debtors prepare to propose their own repayment solutions. We want to hear from you. Share your own credit risk memo and debt repayment experiences, questions, and recommendations with us at Nicara.org. If you found today's episode helpful, please subscribe for notifications of future podcasts. Your feedback helps small businesses stay in business. Until next time, step forward and take responsibility for your own debt repayment solutions. Thanks again.